The mall feels empty and eerie, with no one in sight. Even a quiet word echoes back. Although a few shops are still open, the vacant space and dim lighting give the impression that the mall might shut down any moment. This mall, located in Nanjing and surrounded by 1 million potential customers, now faces closure due to the lack of visitors.
Isn't it ridiculous? It's completely deserted here, with only a bubble tea and a coffee shop open. Everything else is shut down. The physical economy is really struggling. Who knows what the future holds for this mall? Almost everything is closed, even the ground floor. Imagine the upper floors. Honestly, it feels a bit unsettling to work here. Malls should be exciting places, always offering something new. But if no one comes, what's the point?
It's not just these two malls from the video. Supermarkets and shopping centers across China are rapidly falling into disrepair. Take, for example, an empty mall in Yingchuan, another in Nanning, or the nearly deserted Yonghui supermarket on a Friday night. It's as if brick-and-mortar stores are nearing extinction. With China's economy rapidly weakening, the decline of physical stores seems almost routine. On October 28th, major news broke in the Chinese retail sector. The once renowned Taiwanese hypermarket chain Rt-Mart is up for sale. Insiders revealed that Rt-Mart's parent company, the Hong Kong-listed supermarket giant Sun Art Retail Group, is actively seeking buyers. Originating in Taiwan, Rt-Mart made history as the first hypermarket chain designed, planned, and managed by ethnic Chinese. Its story traces back to 1943 in Shanghai, later moving under the Taiwan-based Ruintex Group. In 1996, Rt-Mart was founded in Taiwan, opening its first modern hypermarket in Taoyuan in March 1997. By 1998, it expanded into mainland China, opening its first membership-based store in Shanghai. By 2021, Rt-Mart had opened nearly 500 hypermarkets across mainland China, making global headlines with 24 billion yuan in revenue in 1999. In 2000, it entered a joint venture with French retailer Auchan to boost its global reach. 9 years later, Rt-Mart set a record, reaching 40.4 billion yuan in revenue and surpassing Carrefour to become China's supermarket king. In 2011, Rt-Mart merged with Auchan for an IPO in Hong Kong, propelling Sun Art Retail Group past Walmart to become China's largest retailer. However, the arrival of Alibaba's new retail model and the rise of e-commerce significantly challenged Sun Art. In 2017, Alibaba made a surprise investment, buying a 28.8% stake in Sun Art Retail for $2.88 billion, then upping its ownership to 72%, becoming the controlling shareholder. This deal briefly pushed Sun Art's market value above 100 billion Hong Kong dollars. But soon after, financial struggles emerged. Sun Art fell into operational losses, and its value plummeted, losing over 80 billion Hong Kong dollars from its peak. Rt-Mart's influence on China's retail industry has been monumental, pioneering private supermarkets in the region. But by 2024, the strain became too much. Rt-Mart reported a staggering loss of 1.7 billion yuan for the fiscal year, a decline of over 2,000%. The company attributed these losses to underperforming stores and widespread closures, with over 20,000 employees reportedly leaving. This wave of closures exhausted the patience of its main backer, Alibaba. In response, Sun Art Retail appointed new leadership, finally turning to a veteran of the Rt-Mart and Auchan days, Shen Hui. It's said that Shen Hui joined the French subsidiary of Auchan in 1999, forming deep connections with colleagues from Rt-Mart and Auchan and gaining extensive experience. After stepping away from retail, he ventured into the tourism industry and eventually started his own business. Now, the board has brought him back. However, Alibaba's attitude towards Rt-Mart has changed significantly. Alibaba founder Jack Ma, who often travels abroad, is more focused on expanding e-commerce internationally. Zhou Zai, the current chairman of Alibaba, is more interested in sports and basketball. When Alibaba originally acquired its stake in Sun Art Retail, Zai wasn't involved in the deal. Now, with former CEO Daniel Zhang having left, the patience for R-Mart's issues may be running thin. In the first half of the year, there were reports that Alibaba was planning to sell Rt-Mart and reassess its retail investments. CEO Wu Yongming indicated that Alibaba's primary focus is now on its internet platform, AI-driven technology, and global commerce network, suggesting that the company will double down on tech and be more selective with non-tech investments. This shift means a natural step away from traditional retail. With Sun Art reportedly preparing to sell Rt-Mart, it raises the question, how did the king of supermarkets reach this point? Since late September, the Chinese retail landscape has rapidly shifted, marked by three major events affecting the industry's future. Yonghui Superstores, BBK, and Rt-Mart have all faced significant financial issues. In late September, Yonghui Superstores, once hailed as China's most powerful supermarket with over 20 billion yuan in funding, underwent a leadership change. The popular dollar store chain Miniso, listed on the U.S. stock market, took over Yonghui in a deal worth 6.3 billion yuan, sparking a rare acquisition in the 2024 retail industry. At that time, JD.com, a major shareholder, decided to exit despite incurring losses. Investing in traditional retail was a strategic move by various tech giants to capture market share. The idea was to integrate online and offline services, creating a comprehensive ecosystem. Recognizing this, JD's founder aspired to build a global retail giant, and in 2015 took decisive steps to expand into brick-and-mortar stores, ultimately choosing Yonghui Superstores as a partner. JD's founder Liu Changdong even visited Yonghui's headquarters in Fuzhou, where he commented, "Yonghui's fresh supply chain model is unique, just like JD. It's something others can't replicate." JD then invested 4.3 billion yuan to acquire a stake in Yonghui, making Liu the first e-commerce leader to invest in traditional retail. But things didn't go as planned. Shortly after JD's investment, Alibaba's Jack Ma announced his 5 New strategy, which included new retail as a challenge and opportunity for traditional retailers. In reality, however, Yonghui Superstores faced an operational crisis starting in 2021, resulting in 3 consecutive years of losses totaling 8 billion yuan by 2023. In 2024, Yonghui sought advice from Fadonglai, a unique Chinese retail chain known for its non-standard approach to retail, which had remained independent of big tech investment. The collaboration didn't yield positive results, leading JD to finally pull out of its investment, marking the end of its ambitious retail venture. The impact of Yonghui's financial troubles continued to ripple, and in October, BBK, another traditional retail giant in China, also hit financial hardship. While BBK, founded by Wang Qian, had dreams of being the top retailer, it followed a different path. Wang Qian, one of the most famous figures in China's private retail sector, aimed to keep control within China, avoiding foreign capital influence. He founded BKK to achieve this. However, Wang's approach shared similarities with internet giants, a focus on expanding stores, increasing services, and scaling up employees, aiming to dominate retail. In the tech world, this mirrors the focus on scale and market share. Wang Qian pursued this expansion strategy aggressively, establishing around 50 subsidiaries under a single supermarket. He saw the 2008 Olympics in China as a golden opportunity to scale up BBK and pushed it into the capital market, marking BBK as the first truly publicly listed chain supermarket in private retail. But in 2016, everything changed. Jack Ma's concept of new retail began influencing BBK's strategy. Although new retail brought both challenges and opportunities, for traditional retailers it was primarily a challenge. Traditional retail's asset-heavy model clashed with the asset-light approach of e-commerce, creating an inherent conflict that eventually led to BBK's decline. In 2018, BBK launched its BBK Smart Retail initiative, which had limited success. After struggling to collaborate with tech giants, Wang Qian took a different path, leveraging BBK's resources to enter real estate. However, this was at a time when major Chinese property developers like Wanda, Evergrande, Country Garden, and Vanke were already facing significant challenges. Real estate giants were treading carefully, so BBK's entry was seen by some as a misstep. By 2022, BBK followed Yonghui Superstores down a similar path, facing an operational loss crisis. From 2022 to 2023, BBK accumulated over 4.3 billion yuan in losses. Just like Yonghui, BBK sought help from Fadonglai, a standout in China's retail scene known for its exceptional customer service, employee care, and popular products. In early 2024, BBK invited Fat Donglai's management team to study their model, which includes shorter hours and improved employee benefits. Fat Donglai, often regarded as a unique player in China's supermarket industry, is known for its customer-centric approach and dedication to employee welfare. Despite the assistance, BBK Investment Group ultimately had to file for bankruptcy. While many expected stability to return to Chinese retail, Rt-Mart became the next major player at risk. After years of promoting new retail, Alibaba is now reconsidering its large investments in hypermarkets. Rt-Mart's turning point reflects a broader shift in China's retail industry. The decline of traditional retail results from multiple factors: high costs, intense market competition, and most significantly, a shift in consumer behavior. With the rise of the internet and e-commerce, more shoppers prefer online platforms, which offer convenience, flexibility, and a wide selection of products from different vendors. However, as China's economy slows, even online retail is experiencing a decline, revealing that the underlying challenge for traditional retail is customer reluctance to spend amid economic uncertainty. China's largest shopping festival, Double 11, kicked off its promotions on October 14th, but many retailers and analysts predict that this year's sales may remain flat or only see moderate growth. Many have noted that Chinese consumers are still feeling pessimistic about the current economic climate. According to a Reuters report, furniture seller Wu Qian said he opened a store on JD.com this year primarily to clear inventory, hoping to make a small profit. But he didn't expect significant sales growth. He said, consumers no longer wait for shopping festivals to make purchases. The diversity of e-commerce platforms means there are deals year-round. Estimates from data provider Xintun showed that last year, the total gross merchandise volume on China's major e-commerce platforms grew only 2% to 1.1 trillion yuan, around $156 billion. This is far from the double-digit growth rates of previous years. Independent e-commerce expert Lu Zhenwang commented, "Things are calm now, and suppliers have become more rational. Gross merchandise volume is no longer the core focus. Profits are. But hitting profit targets is challenging because competition remains extremely fierce, and even quality products only sell if prices are lower." In September, Chinese authorities and the central bank promised a range of stimulus measures to boost the economy, including interest rate cuts and stock market support. However, CEO of the Danish brewery Carlsberg's Jacob Aarup-Andersen told the Financial Times that these measures have yet to make an impact. Reports from both Carlsberg and AB InBev indicate that sales in China were below expectations, leaving no clear indication of an economic rebound next year for these international brands. The timeline for China's recovery remains uncertain. Cosmetics giant Estée Lauder has reduced its dividend and withdrawn its earnings outlook due to a sharp drop in Chinese sales. Estée Lauder also warned other companies that the pace of China's economic recovery is slower than expected. Western consumer groups in luxury, beauty, alcohol, and automotive sectors have been hit hard by the slowdown in Chinese spending. Many feel that the current government measures may not be enough to significantly drive economic growth in the coming months. AB InBev CEO Fernando Tenenbaum expressed concerns to the Financial Times, noting that Chinese consumers are becoming more cautious and going out less, which has had a severe impact on AB InBev's nightlife-focused product lineup. Aarup-Andersen also noted that Chinese consumer confidence has significantly deteriorated, with Carlsberg's third-quarter sales in China down 6% and AB InBev's down 14.2%. Last week, Estée Lauder's rival, L'Oréal, cautioned that China's situation is more severe due to the government's crackdown on personal shoppers. On October 15th, French luxury conglomerate LVMH reported a 3% drop in third-quarter sales in China, marking its first quarterly decline since the pandemic began. The chill in retail is spreading, with China Merchants Bank, known as the king of retail, reportedly declining revenues, net profit, non-interest income, and other core indicators for the first 3 quarters of 2023. Meanwhile, total liabilities have risen to approximately 10 trillion yuan, with a 5.56% increase. China Merchants Bank is not alone. Among the 22 A-share listed banks that have released their 2023 annual reports, 13 major banks, including ICBC, CCB, ABC, Ping An, and Industrial Bank, have reported negative revenue growth. This decline is primarily due to the drop in net interest margins, a key measure of revenue growth for banks. Net interest income constitutes 70 to 80% of the revenue for China's major commercial banks. According to the Financial Regulatory Commission, by the end of 2023, commercial banks' net interest margin had dropped to 1.69%. Li Yunze, head of the National Financial Supervision and Administration, also noted, currently, loan interest rates have fallen to historic lows, and banks' net interest margins are at their lowest in 2 decades.